IND AS 101. IND AS 101 talks about first time adoption of IND AS. Okay. Obviously, IND AS is relatively a new affair, right? It's probably coming about 7-8 years back. That's all maximum. Yeah. All right. So first time when you adopt IND AS, earlier you were following accounting standards. Now we are moving from accounting standards to IND AS. So when you're moving from AS to IND AS, there will be obviously a lot of requirements because accounting standards talk a lot of different things. IND AS says something different. So there are a lot of difference between AS and IND AS. So how do we move from AS to IND AS? So you needed some guidance. That's the reason they formulated one standard called IND AS 101, first time adoption, which gives you a guidance. First time when you have to adopt IND AS, what and all you need to keep in mind, or how and all accounting should be done. So this is only relevant for the first time when you adopt IND AS. After that, you don't have to apply IND AS 101. That is one. Okay, that's about the main thing. All right. As a thumb rule, what IND AS 101 says is whenever you shift from previous gap here refers to accounting standards. All right. So whenever you shift from AS to IND AS, as a thumb rule, you have to do a retrospective application. So whatever IND AS ka provisions, sir, you have to apply it retrospectively as a thumb rule. All right, that's a basic rule. Then they'll go on telling certain exceptions, exemptions, etc., etc. But overall basic rule is the provisions of IND AS has to be applied retrospectively, not prospectively, but retrospectively. All right. Now there are few things we'll see about exemptions little later, but first we'll go over a few things. Sir, whenever first time when you prepare IND AS financial statement, sir, you have to prepare something called first IND AS financial statement. Okay, first IND AS financial statements you need to prepare. Sir, what can you call as first IND AS financial statement? Sir, you can call that financial statement as a first IND AS financial statement when an entity makes one remark. If entity makes one remark in financial statement, that financial statement you can call it as first IND AS financial statement. Sir, what is that remark? Entity should make an expressive statement, expressive remark saying they have complied with explicit and unreserved statement of compliance made by the entity. They have to make a disclosure saying they have made unreserved and explicit and unreserved statement of compliance. Entity should tell through that particular financial statement that all the IND AS as per as their knowledge they have applied. All the IND AS as per as their knowledge they have applied. Such a statement, if they make it in a financial statement, okay, such a financial statement we call it as first IND AS financial statement. Okay. So what if our auditor agrees? Company feels they have applied all IND AS correctly first time. Auditor feels no, company has done some mistake. That is irrelevant. First IND AS financial statement is that IND AS financial statement where entity makes this remark. If entity personally feels that they have complied with all the IND AS, doesn't matter whether if auditor agrees or they don't agree, doesn't matter. It will be still treated as first IND AS financial statement itself. That is one. Okay. Partial compliance of IND AS is not enough. It should be a complete compliance from the entity viewpoint, not from auditor viewpoint. Keep that in mind. Okay. Then it is the date of transition. So what is date of transition? Okay, what is this date of transition is? Let's say our current year is 1st April 20X1 to X2. In that year, IND AS has become applicable to us. Obviously, IND AS has certain limits, net worth limits and all. Okay, let's say the IND AS became applicable to us on in the current year, meaning from 1st April 20X1 onwards, IND AS is applicable to us. And this is our current year. So we know this. We don't prepare financial statements only for the current year. We also have to give comparative data. Right, we not only give current year data, but also we need to give a previous year data for comparison purpose. Previous year starts from what date? First, in this my example, if IND AS is applicable for you from 1st April 20X1, even previous year ka financial statement you need to prepare as per IND AS. So previous year ka date starts from 1st April 20X0. That day we call it as a date of transition. So date of transition simply means from what day are you really applying IND AS. Okay, on legally you may say it's applied from 1st April 20X1, but even comparative financial statement has to be prepared as per IND AS only, no? But so in reality, you have to apply IND AS from 1st April 20X0 for comparison purpose. So that we call it as date of transition. Date of transition is basically the beginning of the previous period, like that. So on beginning of the previous period, no, sir, you need to prepare something called on balance sheet. You need to prepare. And remember, we discussed this in IND AS 8. Whenever there is an error or whenever there is a change in accounting policy and you're doing a retrospective application, if the error is going not only restricted to previous year, but it is going beyond previous year, we need to prepare third balance sheet. Here, instead of third balance sheet, we have to prepare something called opening balance sheet. Opening balance sheet is that balance sheet prepared on the date of transition. Here, what is the date of transition? 1st April 20X0. So the balance sheet that you prepare on the date of transition, here we call it as opening balance sheet. Because as a thumb rule, IND AS has the retrospective application. So, but we prepare financial statement only for the current year and give comparative data for the previous year. We don't go beyond that. So if some data you need to capture beyond that, so you need to obviously how do you account that? So we need some data for that, or we need some component for that. That component is your opening IND AS balance sheet, which is prepared on the date of transition. That's what I've given here. Okay, sir. Another one is this particular standard, IND AS 101. It applies for annual financial statements as well as interim financial statement. Okay, that is one. Annual as well as interim financial statement. Interim financial statement, you know, something which is prepared for less than 12 months. That we call it as interim financial statement, which with the standard also we'll cover later on in IND AS 34 in a bit. Okay. But however, if you're doing any changes in accounting policy, that is not considered as a first time adoption. So first time adoption means you are changing from what to what, from you are going from AS to IND AS. When you're doing first time adoption, you are changing something. Your accounting standard metrics you are changing. From AS you are going to IND AS. That means there is a change, right? Okay. Let's say organization went from FIFO method to weighted average cost method. IND AS was already applicable. After IND AS is applicable, they went from FIFO to weighted average or cost model to revaluation model. That means this is also a change, but there is a change in accounting policy. Sir, this can the company tell we have done a first time adoption? Sir, no. Change from AS to IND AS only, we call it as first time adoption. Changing your accounting policy means, yeah, there also you have done a change, but this change is not considered as first time adoption. First time adoption will give you a lot of benefits. That benefits and all you cannot take for accounting policies changes and all. That is not acceptable. Okay. All right. That is one. Next is certain mandatory exceptions or exemptions are there. You know, as a thumb rule I told, from AS to IND AS, if you are transitioning, you have to do the adjustments retrospectively. To that, there are certain exceptions. One are mandatory exceptions. One other one is optional exceptions or exemptions we have. Mandatory exemption is with respect to the estimates. Obviously, to find out a useful life, residual value, provision for doubtful debts and all, you need estimates. So you need to check. In accounting standards also, you will use the estimates. IND AS also requires the estimates. So which estimate should we use, sir? What IND AS 101 first time adoption says is, if your previous gap as an accounting standard, if they are already having estimates, check. If the answer to that is yes, which is obviously yes, and see if there is any error in those estimates. Have you done any errors? Errors we don't know. We know what does error mean now, right? So if there is any error in that estimate, then you can't use those estimates. You have to use IND AS estimates. But however, if you feel the previous gap AS, they have estimates and there was no error in those estimates, then IND AS estimates on the date of transition you can ignore. It's not required because the estimates are all based on circumstance. So when you are applying AS, the circumstance could be different. And later on, when you started applying IND AS, circumstance would have changed. So obviously, based on circumstance, the amount and all also would change. So that's the reason previous estimates you need not revise. Okay, on the date of transition, whatever is your old accounting standard estimate, same thing you can take. No need to change that. Another one is with respect to non-controlling interest, NCI. Normally, the post-acquisition profit, what do we do for post-acquisition profit of subsidiary? We split between parent and NCI, right? So what if it is post-acquisition loss? If it is post-acquisition loss also, we give it among parent and NCI. So let's say NCI balance is only 1 lakh, but post-acquisition loss share is 2 lakh rupees, or let's say 3 lakh rupees. Post-acquisition loss share of NCI is 3 lakh. That means if you do this, NCI balance will become negative. Okay. AS 22 or rather accounting standard on consolidation, AS 21 rather, did not permit this. In fact, in accounting standard, we didn't call NCI. We used to call it as minority interest. What AS 21 said is, you allocate only that much loss to make sure that minority interest balance stays positive or it should become zero. You don't make minority interest balance zero. That's what accounting standard said. But IND AS is nothing doing, whether it is profit or whether it is loss. Whatever is the number, distribute. NCI balance can become positive or NCI balance may become negative. It doesn't really matter. If it is positive, show it as a positive number in your consolidated balance sheet. If it is negative, show it as a negative number. Don't worry about the signs. Just do the allocation is what IND AS says. Okay. But AS did not say this, no. So these sort of allocation, the total comprehensive income, that's what we mean by post-acquisition profit. Because we don't allocate only profits, we also allocate OCI. Hence, I've used the term TCI here. TCI means SPL and OCI items put together. So the total comprehensive income allocated to the parent and NCI should be allocated. And we have to do this allocation even if NCI balance becomes negative. This allocation, you will start doing it only after IND AS is applicable. Okay. You don't have to do it from the beginning. Okay, because already you've been doing consolidated, you might have done consolidation using accounting standard. Now you don't have to change all that. Okay, so this you do it prospectively only. That is one mandatory exemption you have to take. As a thumb rule, you have to do retrospectively, but for this you will do it prospectively only. Meaning from date of transition, you start doing this particular activity. Before that, not required. That is one. Similarly, loss of accounting, loss of control while accounting, change in parent's ownership. Like parent had 60% shares, they purchased another 10% share. All this we say is a transaction happening between equity participants. Any gain loss be transferred to other equity. So all this transaction, we do it only from the date of transition, not before that. Because accounting standard treatment and Ind AS treatment with respect to these are different. So you don't have to break your head in that regard. So do it only prospectively is what Ind AS 101 is saying. It's not an option, it is compulsion. These you have to do it compulsorily. Okay, that is one. And then we have certain optional exemptions, meaning if entity wants, they can utilize it, or if they want, they can ignore it. Totally entity ka choice. One is with respect to business combination. Sir, you were following accounting standards. At that point of time, some business combination you had done. An entity had acquired control of another entity, not at the time of Ind AS application, but before Ind AS was applicable only, Ind AS business combination has already happened. So this we call it as past business combination. Okay, past business combination. Okay, so what Ind AS the 101 says is past business combination need not be restated. Meaning for past business combination, you don't have to do retrospective accounting, because amalgamation AS 14 and business combination, which is Ind AS 103, provisions and many pointers are different. Okay, there are differences. So what optional exemption is given over here? And business combination is not a small activity, right? There are many assets involved, etc., etc. That's the reason. And doing and Ind AS 103 says you have to find out fair value. Accounting standard doesn't talk about fair value. AS 14 there. Okay, so there are differences. That's the reason they're saying don't break your head for past business combination, meaning for those business combination which has happened before transitioning to Ind AS, that whatever you have done, let it continue. You don't have to do retrospective application for that. This is an entity ka choice, which Ind AS 101 is giving. Because considering the quantum of data involved over here, I think this was required. So they've taken practicality into picture and probably devised this particular provision. That is one. Second one is, what they're saying is, standard has already given you one shortcut saying past business combination, do not restate. Standard only is saying don't do it. But entity is being a Bruhaspati. They are saying, no, we will do it. Past business combination also, we will do it retrospectively. Yeah, they are saying, yeah, we have the capability, we'll do it. Now the standard is saying, okay, I have given you a shortcut that past business combination need not be restated. What is the entity doing? They disregarded, or they didn't take that shortcut. They want long cut. That means what did they do? They restated a business combination. So hence in that, if entity does that, what Ind AS 101 says is, if one business combination, if you restate, if one past business combination, if you have restated, after that, what and all business combination you have restated, no? After that, what and all business combination you have done, entire thing has to be restated. It is not partial. Okay, any one business combination is, if it is restated, then entire business combination which came after this restated business combination, all of them also should be restated. So I'll give us an example. Look at this. Suppose the date of transition is 1st April 2025, meaning Ind AS is applicable from this date. Okay, one business combination happened on 1st April 2022. That means it came much before business combination, much before Ind AS applicability. That only we call it as past business combination. Okay, now what does Ind AS 101 say? Past business combination need not be restated, meaning for this business combination, you need not apply Ind AS 103 ka provision. Whatever you have done as per accounting standard, let it continue. Okay, so let entity use the shortcut. Let's say they said we will not restate this business combination, meaning we will not apply Ind AS 103 retrospectively. Is that acceptable? Yeah. Standard gives the shortcut, entity utilize the shortcut. Is that acceptable? Yes. Let's say there was one more business combination which happened on 1st August 2022. That is also much before date of transition. Yeah. This, what did the entity do is they restated retrospectively. They want to do it retrospectively, meaning they want to apply Ind AS 103 from the beginning. From this day, they want to apply. Is that acceptable? Yeah. Standard says yes. I've given you a shortcut. If you don't want to use the shortcut, take the long cut. So here, first option, company took the shortcut. Second, they're going for long cut. Okay. So here they have chosen to restate. What standard says is, if you have chosen to restate one business combination, any business combination which comes later, not before, any business combination which comes after first business combination, that also should be restated. Meaning for that also you have to do retrospective accounting. Meaning you have to do the accounting as per Ind AS 103 only. You can't use shortcut method. Now let's assume that one more business combination came on 1st January 2023. Now company is saying we will not restate this business combination. We'll use shortcut. Is that acceptable? No. Since this business combination you have chosen to restate, chosen to do it retrospectively, the business combination which came later than that, which is this, that also needs to be restated. So the shortcut method which the company wants to do will not be acceptable like that. That's what they mean by that. So any business combination after business combination 2, any business combination in this example which has come after 2 should also be restated, meaning applied retrospectively. That is what we have called out over here. Done. The next one is the para 46A and 46A exemption, which we talked about in Ind AS 21. You remember we discussed this? Okay, the same thing. Okay. So I'll give you a little background again. We've discussed this. If you have any long-term foreign currency monetary item, if you have taken a loan, a foreign currency loan, you need to check for what purpose is that loan utilized for. If it is used to purchase a depreciable asset, then normally forex gain or loss on monetary item as per IND AS 1 has to be, or monetary item should be shown in the reporting period using closing rate, and any exchange gain or loss should be transferred to P&L. This is a normal rule. However, para 46 exemption of accounting standard 11, not IND AS 21. Accounting standard 11 gives you one shortcut. What does that they say? So if you have any long-term foreign currency monetary item, and if that loan is utilized to buy a depreciable asset, then exchange gain or loss need not be transferred to P&L, but you can add it to the cost of the asset. If it is exchange gain, if it is exchange loss, you can add it to the cost of the asset. If it is exchange gain, you can reduce it from the cost of the asset, like that. That is the option given. Okay. However, if the loan is utilized for other purposes, not for a depreciable asset, but for some other purpose, then this exchange loss, you can accumulate it in one reserve called FCMITD or FCMITR, foreign currency monetary item translation difference, or foreign currency monetary item translation reserve. And from FCMITR, it will be transferred off to P&L over loan duration. That's what I had told you when I discussed IND AS 21. I also told you at that time, same thing will come in IND AS 101 also. Okay. So now what you need to check is, if para 46A exemption of accounting standard 11, this para is of relating to accounting standard 11, is that adopted by the company before IND AS? There's an option. This is not a compulsion again. Even AS 11 gives this option. If they want company on this forex gain loss on monetary item, they can transfer it to P&L, or they can use para 46A exemption and transfer it to FCMITD or add it to the cost of the asset. That is also a choice in AS 11. So what you need to first check is this choice, para 46A choice, has the company already taken it up? Before they adopted IND AS, had they taken this choice? If the answer to that is yes, the company has already adopted this choice, then even after IND AS is applicable, they can continue to do the same thing. Meaning the exchange gain or loss, whatever they are getting, because loan means it may last for 8 to 10 years, correct? So even after IND AS, this loan could still have a balance. Now, though IND AS is applicable, since the para 46A and 46A exemption was already applied by the company, same treatment can be followed even after IND AS also. Meaning on this forex loan, if you're getting any exchange loss, still you can transfer it to FCMITD or transfer it to or add it to the cost of the asset, depending on what the case the company has been doing. So that treatment they can continue. Whatever AS treatment they've been following, they can continue. Or company has already has another choice. Now IND AS is applicable, no? So company say, I'll not transfer it to FCMITD anymore. I will transfer it to P&L. Till now they've been transferring it to FCMITD, foreign currency monetary item translation difference. Now on IND AS date, company is saying, I will not transfer it to FCMITD, I'll transfer it to P&L. Is that acceptable? Yeah, that also they can transfer it. Okay. So that means whatever balance is there in FCMITD, transfer it up to retained earnings. Okay. And do it. That's fine. Whatever balance is there, transfer it up to retained earnings, and going forward, whatever exchange gain loss is there, accounted as per IND AS 21, and IND AS 21 says gain loss transfer it to P&L. That is also acceptable. Okay. However, this para 46A exemption was not adopted by the company at the time of AS 11. When AS 11 was applicable, this option company did not utilize. Meaning the gain or loss they were transferring to P&L. This para 46 exemption was not available. The company did not choose. Now can the company choose? Now the entity is saying after IND AS is applicable, I will choose para 46A exemption. It is not acceptable. Only you have chosen before IND AS means you can continue it after IND AS. If you have not chosen this option before IND AS, now you don't have a choice to choose this now. Okay, now means now compulsorily this foreign currency item, this loan ka exchange gain loss, you have to apply as per IND AS 21 ka provision only and transfer it to SPL only. Okay, if you have followed that choice, you can continue with the choice, or you can also cancel the choice and apply IND AS 21 ka. However, if you have not adopted that choice at all, then now after IND AS is applicable, you cannot select that particular option. That's what I'm trying to summarize with this particular table. Okay, watch out for this. This also can come as a nice case study. In fact, we have got some questions on this. Easy only, just have to quickly revise it and understand what they're trying to say there. So that's about exchange difference. Next one is about compound financial instrument. So compound financial instrument means it will have a feature of both financial liability and equity. You need to split it, right? But all the split accounting is there as per IND AS 109. Accounting standard didn't have all this, correct? No, we learned all this only at CA final level. Inter mein our syllabus was so nice. Branch accounting, department accounting, this standard amalgamation, so nicely we have cleared off, correct? Now 101 headache came in the form of CA final IND AS. Yes. So all the split accounting is there only as per IND AS. Accounting standard did not have it. So what they're trying to say is, or what the optional exemption they introduced is, sir, normally compound financial instrument you need to split. Okay, but the split accounting is not required when the split accounting need not be done by the company if financial liability is not outstanding on the date of transition. If this financial liability is already settled on the date of transition, okay, if it is not outstanding, then the split accounting need not be done. That is common sense, no? If financial liability is not there, why do you bother about doing the split up? That's what they're trying to say. Because, sir, wow, that is pretty common sense, no, sir? No. The thing is, whenever you move from AS to IND AS, or yes, it's a retrospective application. So that means all this instrument you have to do it retrospectively, okay? So hence they brought in a practical relaxation that on the date of transition, if financial liability itself is not there, why are you doing a retrospective application? It doesn't make sense. You're doing too much of efforts where it is not required at all. That's what they say. So if financial liability is not outstanding on the date of transition, then you need not do the split accounting. Whatever you have done in your accounting standard, same thing, you can carry it forward. That is one. All right. There are one or two more that you need to remember. Then we will dive into the problems. First is government loan. Sir, if you have received any government loan at below market interest rate, just now we saw the IND AS 20 ka government grant, concessional interest rate. So if you have received any government loan at below market rate, okay, so you know already accounting. Fine. First you have to find out what's the financial liability by discounting present value of future cash flows at market rate. Correct. So if you have any government grant loan that you have received at below market rate, IND AS says one thing. Accounting standard did not have all this, right? As per IND AS, a part of that loan you will treat it as a loan, financial liability. Another part you will treat it as government grant, meaning deferred income. And that deferred income you will transfer it to P&L over the condition ka period. So that is the accounting as per IND AS 20. But accounting standards didn't have all this funda. What simply accounting standards said, if you have received any loan from the government, account it as loan. Doesn't matter whether it is at market rate, lower market rate, higher than market rate, irrelevant. You simply show it as loan is what the accounting standard said. Or in fact AS 12 that their side is, if this government loan is in the nature of promoter's contribution, then you can show it as capital reserve. That's another option that they had given. So here what they in IND AS 101 say, that means obviously we get that the AS ka treatment with respect to this and IND AS ka treatment with respect to this government loan is completely different, right? So what the optional, these are again optional exemption, what they're trying to say is, such loan received before the date of transition, meaning before IND AS was applicable, if you have received such government grant, applied prospectively, no need to apply retrospectively. Okay, meaning only whatever is the carrying amount of the loan as per AS, same thing you make it as financial liability as per IND AS. Whatever loan you're showing as per AS, same thing you do it, show it as financial liability as per IND AS. Okay, no need to do it retrospectively. The split accounting and all not required. So that's what they mean by applied prospectively. Okay, so no need to go back. The reason why it's not required is, sir, if you want to do the split accounting, you need to know the market interest rate. The loan would have received many years ago. So to go back and find out all that data is a Herculean task. That's probably they said that whatever is the loan as per AS, same thing you showed as financial liability as per IND AS also, because going back and figuring it out, the rate may not be a easy exercise. That's the reason maybe this practical relaxation is given. There's an option. However, if the company wants, they can also do it retrospectively. Standard is recommending or standard is saying, giving a shortcut, do it prospectively, meaning no need to do the split. However, if company says, no, I will do retrospectively. So if you do it retrospectively means you have to do it as per IND AS. What does IND AS say? A portion of the loan will be financial liability, another portion will be related to government grant. Okay, but if you want to do it respectively, all the information should be available. Only then you can do it retrospectively, otherwise no. Okay, so if you want to do it retrospectively, this information, market related interest rate, etc., has to you have to know, you have to have this. Only if you have this information, then only you can do it retrospectively. If company has this, then yeah, well and good, they can apply it retrospectively. If they don't have it, then compulsorily they have to go for prospective accounting only. We also see this in a couple of questions going forward. It is there. Okay, next. Sir, if you want this notes, as I told you, sir, Agarwal ji, you can buy it from our website. Okay, Chartbook will not be able to share it to you. Okay, you can buy it from our website. I think yesterday I showed you. You can visit our website, learn.arivopro.com or online.arivopro.com and buy the Chartbook. Okay, soft copy will not be shared, sir. Okay, next is with respect to investment in subsidiary, joint venture or associate. If you have any investment made in subsidiary, joint venture or associate, okay, how to do the valuation? All right, there are three possible ways and any of the three are acceptable. One, whatever is the carrying amount as per accounting standard. Same thing, you can make it as carrying amount of the investment on the date of transition. At the time of in accounting standard, if you are valuing this investment, let's say 10 lakh rupees, on the day IND AS became applicable, on the date of transition, same 10 lakh you can show it as value of the investment. That is one. Sir, investment will not come, no sir. Sir, investment will not come in consolidated financial statement. It will come in separate financial statement, you know. Okay, that we are talking about it here. So carrying amount as per accounting standard only, you can make it as carrying amount as per IND AS also. Easy. Whatever is shown there, make it as same here also. That is one option. Or find out the fair value of the investment on the date of transition. What is the fair value of these investments on the date of transition, you try to find out. Okay, and the fair value you can adopt it as, or whatever is the fair value, you can show that as the investment value. That is another acceptance. Either carrying amount as per previous GAAP, that is AS, or fair value on the date of transition. Or you can value as per the cost as per IND AS, meaning this is your retrospective application. Okay, because IND AS 27 says what, sir? Either you can go for cost model or fair value model, right? So you can value as per the cost also, but this cost you have to determine as per IND AS 27. Cost as per AS and cost as per IND AS 27 may not be same. So if at all you want to do at cost, means you have to find out the cost as per IND AS 27 only. So that means indirectly this is your retrospective application. Okay, choice is yours. Most of the organization will go for the first option only. Easy, no? Yeah, who will work out so much? Yeah, but all the three are acceptable. One among the three, the company can choose on the date of transition. This is with respect to investment in subsidiary, associate, and joint venture. Either carrying amount of the previous GAAP or fair value on the date of transition, or the cost as per cost you can value. Cost here refers to original cost, but this cost has to be as per the IND AS 27 cost, not accounting standard wala cost. Okay, that's one. Next is with respect to PP, intangible assets and investment properties. If you have PP, property, plant and equipment, intangible assets and investment property, here also you have been given three leeways. Okay, one is apply IND AS 36, 38 and 40. PP ka standard, intangible asset ka standard and IP ka standard. That standard you apply it retrospectively. Apply it because you're moving over now from what, sir? Earlier you used to value PP under AS 10. AS 10 ka certain provision and IND AS 10, 16 ka certain provision may not match. So these provisions you can apply it retrospectively. That is one. Okay. First option. Or whatever is the carrying amount of the previous GAAP. Whatever is the carrying amount as per accounting standard. Same thing can be adopted as deemed cost on the date of transition. Whatever is the value of these assets you are showing as per accounting standard. Same thing you can show it as IND AS also. No extra working necessary. Cut and paste. That is one. Or find out the fair value. Same like the above. Find out the fair value of PP or intangible assets on the date of transition. Whatever is the fair value on the date of transition, that itself becomes IND AS ka value. That is another one. But for investment property, fair value is not allowed, because we know that investment property only cost model is allowed. Fair value is not allowed. So fair value is only applicable for on the date of transition. Fair value on the date of transition is only applicable for intangible assets and property, plant and equipment, but not for IP. That is one. Okay. Sir, one more thing you probably need to keep in mind is if entity adopts fair value on the date of transition. Can they adopt fair value on the date of transition for PP and intangible assets? Yeah. So if entity adopts fair value on the date of transition, it will not be considered as a change in accounting policy. Sir, what do I mean by that? Sir, till now, let's say company is following cost model. Sir, even accounting standards have cost and revaluation model wala concept. So till now, let's say they are following cost model for their PP. They are valuing their PP under cost model. Now on the date of transitioning to IND AS, on the day IND AS is applicable, they want to adopt fair value on the date of transition. So till now you are following cost. Now on the date of transition, you have chosen to go for fair value. That means you have changed. Is it a change in accounting policy? No, this is not considered as a change in accounting policy because you are moving. So change in accounting policy means you have to do retrospective accounting. First of all, these are all shortcuts. Okay. Now if you say this is the accounting policy means you have changed accounting policy, you have to do it retrospectively. We don't want to do retrospective accounting, so only that's the reason these shortcuts are given. Okay, that's the reason they specifically told out that this, if you adopt fair value on the date of transition, it is not a change in accounting policy. That is one. Okay, so let's continue it further. Let's say you adopted fair value on the date of transition. At the end of the year, let's say you went for cost model. Because fair value on the date of transition is what, sir? You have to bring the value as per IND AS now. That value as per IND AS you adopted as fair value. Okay. So initially you chose to value this particular asset as per IND AS at fair value. Then at the end of the year, we know that this becomes subsequent measurement. Subsequently, again, they went for cost model or they went for revaluation model, whatever. Let's assume it as cost model. So on the date of transition, they went for fair value. They adopted fair value. At the end of the year, they've gone for cost model. Is this a change in accounting policy? No, sir. This is also not a change in accounting policy. Basically, what the standard is trying to say is for the first year, you can play whatever. You can play around whatever. Meaning you can adopt fair value on the date of transition and at the end of the year, you can go for cost model. Or you can adopt carrying amount on the date of transition as per previous GAAP and adopt revaluation model at the end of the year. So you can play around the way you want it in the first year. We will not treat it as change in accounting policy because if it is change in accounting policy, you have to redo the working from the beginning. That is not our intention. That's the reason first year In the date of transition wala year, that year, no, you can do whatever you want. After that, let's say you were following first year end, you followed cost model. Second year end, you went to revaluation model. That will be considered as change in accounting policy. But in the transitioning year, you can play around. From the date of transition till the end of the year, you can do whatever you want. You can play around with these models. It will not be considered as a change in accounting policy. This is a practical relief here. Okay, that's one. Another one is, sir, carrying amount of PPE, can you adopt it as deemed cost? Carrying amount as per accounting standard, can you adopt it as deemed cost? Yes. But there is one more extra point you need to remember here is, sir, business combination. Okay, let's say one of the business combination, you restated. Past business combination, you restated. If you restate one business combination, that means what you have to do? All subsequent business combination also you need to restate. But stop there. Forget about the subsequent one. Sir, if you have done a business combination or a restatement, that means you need to apply IND AS 103 retrospectively. What does IND AS 103 says? All assets and liabilities of a subsidiary company has to be recorded at, or net assets of subsidiary company has to be recorded at fair value. The stress there is fair value. Now, if some part of the asset, let's say we have property, plant and equipment, in that, let's say we have 10 assets. Okay, let's say we have totally 10 assets. In that, 8 assets is normal, it belongs to parent. 2 assets came from subsidiary company. We totally have 10 property, plant and equipments. 8 belongs to parent only, 2 belongs to subsidiary company. Okay. Now, business combination, they restated. Business combination, they restated. Correct? This business combination, they restated. If they restated means, can they value this 2 property, plant and equipment, which came from subsidiary, can they adopt carrying amount? No. Since you have restated business combination standard says what? All assets of subsidiary company has to be valued at fair value. So that means the deemed cost exemption of PP is not available. Deemed cost exemption of PP is not available for what assets? For those assets which came as part of business combination. So these 2 assets came as part of business combination, correct? No. Parent is recording these assets because it has come as part of business combination, right? So if you have restated a business combination, not necessary, it's not a mandate to restate, but if at all company has restated a past business combination and these 2 assets has come through business combination, then for these 2 assets compulsorily you have to go for fair value only, cost is not allowed. However, for this, company has a choice. They can go for carrying amount of previous gap, they can go for fair value, whatever they want they can do in that particular case. Only here there is a restriction. That's what I've written here. If past business combination is restated, then the deemed cost exemption is not available for PP for these assets that are part of business combination, not for entire assets. Only for those PPs and intangible assets in investment property which came as part of business combination. Only for that, deemed cost exemption is not available. For rest of the PPs, you can take the deemed cost exemption. Okay, sir? Yes, sir. So this is about the concepts of IND AS 101. So let's kind of strengthen our understanding with the help of some more questions. I think we'll get our understanding better only when we solve few questions. No? Yeah. So we'll solve few questions. All right. Question number 18. Sigma Limited issued 30,000 6% convertible debentures of face value of 100 each. 1 minute. Once again, guys. Coming back to the question, Sigma issued 30,000 convertible debentures of face value 100 each at par. These debentures are redeemable at a premium of 10% on 31st March 20x5. So that's about 4 years, I think. Or it may be converted into ordinary shares at the option of the holder. Okay. So I think we know what this is. Probably CFI this is. The interest rate of for equivalent debentures without conversion option is 10%. Because you gave this conversion biscuit, they are ready to settle for lower interest. So this is definitely a compound financial instrument. So you need to split, but you need to do split only as per IND AS 109. Accounting standard didn't have all the split. The date of transition to IND AS is 1st April 20x3. So you issued this instrument on 1st April 20x1. After 2 years, your IND AS is applicable to you. Okay, that's one. Suggest how the sigma should account for this compound financial instrument on the date of transition. Present value, interest factor they've given. At 6% we don't want. We want market present value, right? So 10%, what is the discount factor they've given? This is your normal loan, not your government loan, not normal loan. What is normal loan? What does it say? So as a thumb rule, all IND AS, when you transition to IND AS, you have to do it retrospectively. So you'll have to apply this retrospectively, meaning from the beginning you need to work out. So from the beginning, if you had worked out from 1st April 20x1, if you had worked out the same instrument under IND AS, what would have been your working? So there's a compound financial instrument. You need to split between equity and financial liability. Yes. So how do you find out financial liability? Present value of future cash flows discounted at market rate. The market rate is 10%. So there's a discount factor is available to you. Yes. You have present value of future cash flows here refers to interest and principal. Since the option is with the holder, it's optionally convertible. For optionally convertible, we take both principal as well as interest. So first find out that. So the interest amount is how much, sir? 30,000 into 100. So 30 lakh is the debenture ka value into 6% is 1,80,000, right? 1,80,000 is the interest. So I've taken PVIF factor. So the total of all the discount factor, which is 3.17. And fourth year ka PVIF, which is 0.68 for principal. Principal, don't take 30 lakh. You have to redeem this principal at 10% premium they told. So you will not repay 30 lakh. You'll pay 10% more. So you'll pay 33 lakh. That's a principal value. So if you add this, you're going to get total present value of future cash flows. That is this. I think they've juggled up the value. That should be 28,14,600. That is the value of your debt or financial liability. Yes. So what is how much did you issue this instrument for? 30 lakh. So in 30 lakh, if 28,14,600 is financial liability, means balance will be equity, which is 185,400. Yes, no, sir. Okay. This would have been the financial liability on initial recognition. Initial recognition means 1st April 20x1. Is IND AS applicable to you on 1st April 20x1? No. What is the date of transition? Date of transition they're saying is 1st April 20x3. So you need to know the value of financial liability and equity on the date of transition. So first find out that. Financial liability, how do you do the accounting? Put up ACM table. For equity, there is no remeasurement. Whatever value you found out here, same will continue. Financial liability, you need to put up ACM table. They put up ACM table. They book the interest charges using effective interest rate. There is no transaction cost and all. So this will be same. They booked it and the closing balance they have got it to be 30,27,666. That's the value of financial liability on 31st March 20x3 or 1st April 20x3, meaning on the date of transition. Okay. Now you have to, it is applicable only from 1st April 20x3. No? So value of financial liability on this date. You work it out retrospectively, but on the date of transition, you find out the respective balance. Okay. So you have to record financial liability at this value, equity, no remeasurement. So same 184,400 you will take. And whatever you are showing the value of liability as per your accounting standard, that you need to cancel. Because accounting standard doesn't have this liability, equity, financial liability, equity wala split up and all. You would have just showed it as a debenture. That's all. Because there's no split up. How much did you issue this debenture for? 30 lakh. But as per accounting standard, you will not show this at 30 lakh. Because there is a premium element. No? How much is the premium? 3 lakh. Yes. So you already passed the journal entry for this in your 11th CPT, 11th, 12th and all. So when you issue the debentures and if you're redeeming it at premium, the journal entry will pass as bank account debit 30 lakh to debenture 30 lakh. And then they'll also book something called in the same journal entry. 4 components will be there. Bank account debit 30 lakh, loss on issue of debentures 3 lakh, 2 debentures account 30 lakh, 2 premium on redemption of debentures 3 lakh. Like this we used to pass the entry. Remember? And that loss would have been, how much is the loss over here? 3 lakh. You'll amortize it over the duration of the debentures, which is 4 years. Okay. Yes. That means 2 years is already over. So every year the loss is 75,000. So 2 years loss is 1,50,000. So in this 3 lakh, 1,50,000 loss is already recognized. That means you still have a balance of how much? 1.5 lakh. So the carrying amount of this loan as per your accounting standard will not be 30 lakh. It will be 31.5 lakh. Because total loss on redemption of debentures is 3 lakh. That also will be recognized as per AS. So 2 years is already over. So 2 years ka loss you already transferred. The remaining loss is 1.5 lakh. So the carrying amount of this liability as per AS will be 31.5 lakh. 30 lakh plus 1.5 lakh of loss, which is 31.5 lakh. That you need to cancel because you can't do the accounting as per AS now. You have to do it as per IND AS. So whatever you're showing as per AS, first you cancel that. It's a liability. It has credit balance. To cancel, debit it out. Then now you need to show financial liability now. What is the value of financial liability? 30,27,666. Show that. Then that's all. No, there's a compound financial instrument. So you need to show equity also. What is the value of equity we got? 185,400. Show that. The journal entry will not match. There will be a difference. Transfer that difference to retained earnings. This is a balancing figure. That's all. Whatever you have done from AS, you need to cancel. And IND AS treatment you need to give. But on the date of transition, you will pass all this on the date of transition. But you have to work out the data from the beginning. That's what we mean by retrospective application. Work it out from the beginning and give its effect on the date of transition. That's all. Okay. Yes. Next one. Mathur India Private Limited has to present its first financial statements under IND AS for the year ended 31st March 20x3. Date of transition is 1st April 20x1 because even comparative financial statement they need to give, no. So the current year may be 1st April 20x2 to 31st March 20x3. But even comparative financial statement they need to prepare as per IND AS. So hence the date of transition will be beginning of the earlier comparative financial period, which will be 1st April 20x1. That is your date of transition which they have given over here. Okay, so some adjustments they have given on the date of transition to IND AS. What are those adjustments? The company opted for fair value of this land on the date of transition. So land is a PP. They want to adopt fair value of PP on the date of transition. Is that acceptable? Very much acceptable. You can do it. You can adopt carrying amount of the previous gap, that is accounting standard, or fair value, or you can choose to do it retrospectively. Any choice is applicable. Here fair value they want to go for. Awesome. The fair value is on the land on 1st April 20x1 was 10 crore. Carrying amount was as per the existing gap. Existing gap means accounting standard. As per accounting standard, you are showing the value of the land at 4.5 crores, but the fair value of the land is 10 crore. And the company wants to adopt fair value on the date of transition. Is that acceptable? Yeah. That means what you have to do? Land value, you have to increase it by 5.5 crores. So land you will debit by 5.5 crores. There has to be another effect. Other effect will be, I think here they've given it in retained earnings, but in my opinion, it should have been given in OCI. One problem, I think study material has put it in retained earnings. Another one, this one under retained earnings. One more, they have shown it under OCI. It's a revaluation surplus, no? Okay. So I think it should have been put under OCI, or it's debatable also. It's a transition adjustment. All transition adjustment, you can argue that it has to be routed through retained earnings also. So there is a little bit more clarity required on this for the time being. I'll also review. If I come across anything, I'll tell you. But both the treatments they've done, maybe both are acceptable. I'm not sure about that. Okay. So this is one. So here they've increased it by retained earnings. But I think OCI is better. You have to increase OCI, revaluation surplus, by 5.5 crores is what I personally feel. Okay, next. Company has recognized provision of proposed dividend of 60 lakh and related dividend distribution tax. It's abolished now, but nonetheless, it's okay. During the year ended 31st March 20x1, it was written back as opening balance sheet. Okay. Sir, dividend, no sir. Now it's changed in accounting standard also, but earlier, no sir. The moment you, excuse me, so dividend you can account it only when it is declared, not by the board of directors. When the dividend is declared and approved by the shareholders, that day you account it. Okay. So when it's proposed by the directors, no, you will not account it. Earlier, no, as per accounting standards, not now or before, when the moment the dividend got proposed by board of directors, we used to account it off. Now in AS also that provision has changed. Okay. As per company's rule only, I think we've changed that. Dividend will be accounted only when it is approved by the shareholders. So since dividend is already recognized, they are saying now you need to write back. So you need to cancel that dividend because it is not yet approved by the shareholders. That's the reason. So 60 lakh of dividend and 18 lakh of dividend distribution tax we need to write back. We already made the provision. Okay. So P&L has been reduced and provision has been increased already. So hence now what we have to do? We have to do the ulta. I think they are only asked the other equity part over here. That's the reason they are not giving full treatment. So basically provision you need to increase over here, and as well as retained earnings you need to increase. So the journal entry you will pass as provision for dividend or whatever name that you're giving for that to retained earnings account 0.78, including your DDT amount, because they would have made the provision including that. Okay, that's one. So retained earnings due to this has to increase. That's the effect. The company fair values its investment in equity shares on the date of transition. The increase in fair value is 75 lakh. Okay, so I mean you have to increase the fair value of the investment. It's an asset. Asset value you need to increase. So the journal entry will pass as financial asset account debit 75 lakh to retain earnings. All this transition adjustment we routed to retain earnings. So to retain earnings account 75 lakh is the entry you need to pass that. So because of this entry, again retain earnings will increase. The company has an equity share capital of 80 crore. They have a redeemable preference share capital of 25 crores. Sir, as per accounting standard, no sir, preference share capital also we used to show it under share capital only. We used to show equity share capital as well as preference share capital. But as per IND AS, you need to see whether preference share capital is in the nature of equity or in the nature of financial liability, and accordingly do. So preference share capital as a separate category is not there as per IND AS. These are redeemable preference share. So obviously it has to be classified as financial liability. So it will not come under your equity portion. It has to be shown under financial liability portion, and such value is 25 crores. The reserves in surplus on 1st April 20x1 on the date of before transition into IND AS was 95 crores, representing 40 in general reserve, 5 in capital reserve. That means out of 95, they're saying 40 is in general reserve, 5 is there in capital reserve. That means balance will be your retained earnings. No? Balance will be what, sir? But in 95 में से 45 is these two means 50 will be your retained earnings का balance. Okay, that is as per accounting standard. Okay. Okay, 5 crores of capital reserve acquired out of business combination. Balance is surplus and retained earnings, which you already found out. The company identified that preference shares are in the nature of financial liability. I think we figured that out. What is the balance of total equity? They're not asking you to prepare whole balance sheet and all. They're only asking you to tell what is the balance of total equity. Total equity here refers to equity share capital and other equity. Okay. On 1st April 2021, after you move over to IND AS. After you move over to IND AS, what is equity and equity, other equity ka balance they're asking. Show the reconciliation between total equity as per accounting standard and as per IND AS. So obviously it will not match, but reconciliation they're asking you between AS and IND AS ka equity. So first we'll find out what is equity and other equity as per IND AS. First let's take the balance. As per IND AS, equity share capital will come, which is 80 crores. Will preference share capital come up? Because we had two shares. We had equity share capital of 80, we have preference share capital of 25 crores. Will preference share capital come in equity and other equity now? No. It is in the nature of financial liability, so that will not come. Now, various adjustments have been done. So due to this, balances will change. But first, before that, let's call out. General reserve and capital reserve balance will be same, 4 and 5 respectively. Retained earnings we already found out, which is 50. Just now we found out, right? That is opening balance. Now give your transitional adjustment. That's all. First is what's it? Land ka fair value you need to increase. By how much? 5.5 crores. Ideally should have increased revaluation surplus, but here they've increased retained earnings only. So due to this adjustment, retained earnings will increase by 5.5. That is one. Okay, next they told what's we already written. So due to dividend adjustment, retained earnings again has to increase by 0.78 given. Next, some investment fair value had to increase, and due to that increase, retained earnings will increase by 75 lakhs or 0.75 crores. That you need to add. Once you add this, you will get what's the equity and other equity as per IND AS. That was one. Now this is IND AS ka equity and other equity that they are asking you to reconcile with accounting standard ka. What was accounting standard ka equity and basically accounting standard ka shareholders funds we used to call it there, right? So what is the shareholders funds as per accounting standard? What and all will come? Basically equity share capital, preference share capital, and your all the reserves and surplus we used to show it there. Yes. So equity share capital is 80. Even preference share capital used to come under this category only. And then your reserves and surplus. Total reserves and surplus they only gave as per accounting standard. Where is that? Somewhere here we saw now, which is 95 crores. 95 had 3 split up. A portion of this is general reserve, capital reserve, another portion is retained earnings, which we have taken. So if you add everything, you're going to get 200. So as per accounting standard, it was 200. But as per IND AS, it's only 182.03. So from 200, you have to get to 182.03. How will you get it? 1. Can you show this preference share capital under equity and other equity anymore? No, it's financial liability. So reduce that. That is 1. Then now all this you need to transition adjustment you need to give. Okay. Increase. You have to increase the value of the investment 0.75 crores. And you have to increase because of dividend adjustment, your retained earnings again should increase. Yes, no. One is a dividend adjustment you need to add back. Another one, or maybe one by one we'll take it. First you need to, since you are increasing the value of the investment, retained earnings will increase by 0.75. That is what they've given here. Okay. Then due to proposed dividend, again your retained earnings should increase. Increase by how much? 0.78. Add that. Next to, you have done a fair valuation of the land. Due to fair valuation of the land, again your retained earnings will increase by how much? 5.5 crores. So basically add this. That's all. So once you add it, you're going to get 182.03. Simple. From 200, you have to get to 182.03. Basically transition adjustments you need to add. Transition adjustment mostly are done in retained earnings. Okay. That's all is this particular question. All fine. Yes. Next one. Government of India provides loan to MSMEs at below market interest rate. Okay. Government is giving a loan at below market interest rate. Stop there only. Whenever government is given loan at below market interest rate, what does IND AS 101 ka first time adoption says? Don't do it retrospectively, do it prospectively. Okay, so that means you don't have to worry. Whatever is the carrying amount of the loan as per AS, same thing you make it as carrying amount of the loan as per IND AS. Don't have to break your head at all. That is one. However, if you want to do it retrospectively, then you need to have all the data. Then only IND AS permits it. So here checks it. Company A ka date of transaction is 1st April. In 20X2, company had received a loan of 1 crore at below market rate of interest from the government. Under Indian GAAP, as per accounting standard basically, company had accounted the loan as equity and carrying amount was 1 crore. Maybe this grant was, this is a loan that you received, no, was in the nature of promoter's contribution. And AS says, any loan in the nature of promoter's contribution, you should transfer it to capital reserve. Capital reserve comes under equity. That's the reason they've recognized this as equity as per accounting standard. But as per IND AS, can you show this as equity? Carrying amount, you can take it as same, but can you show it as equity? No, this is a loan. So loan, you have to show it as what? Financial liability. So classification has to be changed, but amount need not be done. You can do it prospectively. Okay. So amount repayable will be 1.25 crores later on in 31st March 20x9. Effective interest rate is 5.0, 5.74%. So on the date of transaction, what do? Whatever is the value of the loan as per accounting standards, same thing you make it as value of the loan as per IND AS. But as per AS, it was shown as equity. So cancel equity and book it as financial liability. So you'll write equity account debit to financial liability. How much value? Same 1 crore itself, carrying amount of old IND AS. Henceforth, you apply IND AS ka provision. How should this financial liability be valued at? Using ACM method. Yes. Now put up an ACM table. So opening balance of the loan, you'll take it as 1 crore and you'll start booking finance charges and interest charges at the effective interest rate of 5.74%. For how many years? You're on 31st March, on 1st April 20x5. Loan will get repaid on 31st March 20x9. So 6, 7, 8, 9. For 4 more years, you need to put up ACM table. When you put up, the balance will become 1.25 crores. That you will repay at the end of 4th year and the loan balance will become 0. That will account. Okay, meaning you have done this basically on a prospective basis, not retrospectively. And standard also says the same thing. Do it under prospective basis. Okay, that's what we have done. Okay, yes, sir. Next question 23. All these are easy questions. Quickly revise them once. If you have practiced before, it's easy. Otherwise, just have a look at it once more. You will be able to get it, just in case you're having a feeling. Because I have to complete few things under stipulated time. I can't spend too much time also, because if I spend too much time on this, for others, some of them may feel it's maybe too much time consuming. So that's the reason I would have to maintain a certain standard pace. For those of you who feel, no, it's become little too much for us, revise it once more. Whatever I'm saying, it just after this session is over, take that question once again and revise it. Aramse, you'll be able to get it. Okay. Okay, next one. H Limited has the following assets and liability as on 31st March 20x1, prepared in accordance with previous GAAP. So this also one question is popular. What is that? This, sir, they will give you balance sheet as per accounting standard. Okay. Then they will say company has moved over to IND AS. Now we have to redraft the balance sheet as per IND AS. Okay. Question will look very lengthy. 1 or 2 page ka, like almost 1 page ka balance sheet will be there. 1 whole page ka adjustment they will give. Another 2-3 page ka solution will be there. Okay. The moment you look at it, 5-6 pages, no, people will be like, oh, going. But these are the very easiest problems. The reason is simple, sir. They will give some classification changes. They will write a lot of stories. Para, if you see the adjustment, 4 lines for each point they will write. Make it look very, very big. But in reality, hardly anything will be there in such question. You just have to take the data and dump it. Hardly some 4 or 5 components will change. That's all. Rest everything will be ditto only. Okay. But for the namesake, it will look like a very lengthy problem. Just look at this if you want. Now PP is there 1 crore 34 lakh 50,000. First, I'll quickly review that and then I'll take you through the adjustment. Main content will be there in the adjustment. The prepared note. Okay. Investment in S Limited. Okay. Fine. All right. Excuse me. What is that? So investment made, you will obviously show it as a financial asset. This is one. Now the thing is, you need to be careful is whenever you are preparing balance sheet as per the IND AS, right? Do remember in fact in AS you used to present liabilities first and then the assets. In IND AS first you present the assets and then the liabilities. That is one checkpoint you need to keep in. Another one is classification. In AS we didn't have financial asset, financial liability and all. Here you have to see. You have to give that. Okay, if it is a financial asset, you have to show them under financial assets only. For that also marks will be allocated. That is one you keep in mind. And certain values will change, which I'll take you through in this question. So investment, trade receivable is a financial asset. Advance paid for the purchase of inventory. If you paid any advance to purchase inventory, you have a right to receive goods. You don't have a right to collect cash. So it is not a financial asset. So you have to show it under other assets, not as a financial asset. Inventory is not a financial asset. Cash is a financial asset. So first identify that in these sort of problems. VAT deferral loan. So it's a loan, so probably a financial liability. Okay. So maybe it's a loan from the government. If it is a government loan, then we'll have to see what to do. Okay. So creditor again is a financial liability. Short-term borrowing is provision. It's a normal current liability. That's what they've given. Then they've given cumulative translation difference. Maybe this is your FCMI TD. We'll have to see. ESOP reserve is there. We'll see what to do for that. Then we have retained earnings. All this, let it be there. Let's go over the adjustment. That is where the maximum crux of this particular problem will be. First, PPE. In relation to PPE, following adjustments were identified. Property, plant and equipment comprised of land held for capital appreciation. Oh, you have held one land for capital appreciation means it is what, sir? It is an investment property. Can you show PPE and investment property together? No. But what have they done? They have shown it together because AS mein there was no investment property separate classification, right? So here in AS mein we do have it. So investment property should be shown separately. You can't show the entire amount. How much is the value of that land? 4,50,000. So in this 1,34,50,000, 130 lakh will be towards PP and 4.5 lakh towards IP. You need to show it separately. That is one change. So if you look at the solution ka balance sheet, that's what you need to show. PP you need to show separately. Investment property you need to show separately. 4.5 lakh is included in PP now. Reduce it and show it separately. That's okay. 1 or 2, 1 mark will be allocated for this adjustment if you do it properly like this. Okay. Many things will be small ones will be there. Exchange difference of 1 lakh were capitalized to depreciate probably plant and equipment. So probably they are using para 46 exemption. Okay. No retirement obligation, meaning no DSR cost is there. Management intends to adopt deemed cost exemption of using previous gap carrying amount as deemed cost on the date of transition for PP and investment property. So they don't want to use fair value. They want to go for deemed cost exemption. Is that acceptable? Yeah. Either you can go for fair value on the date of transition or carrying amount as per previous gap only. You can take it as deemed cost. Both are acceptable. So that means whatever company wants to do here is acceptable. We don't have to worry anything more on that. The company made investment in Nest Limited at 48 lakh that carried a fair value of 68 lakh. Okay. On the transition date, company intends to recognize investment at its fair value. So you made some investment in subsidiary. Okay. So can you recognize investment on subsidiary at fair value? Yeah. Either you can go for carrying amount as per previous gap or fair value, or you can find out cost as per IND AS. All are acceptable. So company wants to go for fair value. Is that acceptable? Yes. So currently they are showing it at 48 lakh. Fair value is 68 lakh. So investment value, if you want to show it at fair value, investment value will increase. Yes. So due to this, investment value will increase by 20 lakh. Correspondingly, you will pass the journal entry, financial asset, investment account, debit. Okay. To what? You have to credit something that will be credited to retained earnings. So because of this adjustment, investment also will increase by 20 lakh. Here they've shown investment in solution. It will increase by 20 lakh. Correspondingly, retained earnings also will increase by 20 lakh. Retained earnings by there will be many adjustment. So that's the reason. As and when we identify one by one, we'll take off. So current retained earnings given is 1,79,000. That is given as per AS. So due to this adjustment, it will increase by 20. Okay, that's one we have identified. Let's come back now. Next, what else is there? VAT deferral loan. The VAT deferral loan of 60 lakh was obtained on March 20x1. Okay, 1 second, sir. So when are you transitioning to IND AS? 1st April 20x1. When did you obtain this loan? 31st March 20x1. Sir, 1 day before you transition to IND AS, you got this loan. Now probably it's a government loan. What does government loan standard says? Sir, do it prospectively. Okay. But if you want to do it retrospectively, you need to have all the information. Now you think logically. If company says they want to do retrospective application here, can they do it? Yeah, very much yes. Because 1 day before they transition to IND AS, they receive this loan. Correct? No. That means all the data information should be available here because the difference is not so much. If it was 5-6 years back or 8 to 10 years back, finding the data 10 years ago was probably an issue. Here it's looking at like 1 day before, right? So that means what? Data will be available. Most probably here they will say company wants to do retrospective application. Let's find out. So deferral loan is 60 lakh. So company is currently showing the loan in their balance sheet at 60 lakh if you just check. Because as per IND AS and all, no, there is no split up of financial liability and government grant. If you have received a loan from government, you show it as loan. That's all. Okay. All right. For setting up a business in backward region in condition that defined targets are met. Okay. The loan does not carry any interest, but it is repayable at the end of 5th year. The discount factor they have said is 10%. Okay. Being the incremental borrowing rate. The fair value of the loans are normally we have to find out the fair value of the loan. They have only given, which is 37 lakh 25,528. So they have only found out the fair value of the loan. Okay. How much loan? 60 lakh. So in 60 lakh, if fair value of the loan portion is 37 means the financial liability portion is 3725 to 528. Balance will be treated as government grant. Okay. All right. The entity chooses the option para B of IND AS 1. That is, entity chooses the requirements of IND AS 109 to account government grant and disclosure retrospectively. So that means they don't want to do it prospective accounting. They want to do it retrospectively. Here all the information seems to be available. So can they do it retrospectively? Very much yes. So if they choose to do it retrospectively, now entire loan you can't show it as entire 60 lakh you can't show it as loan. So in your if you look at the balance sheet now, financial liability they will show the loan only at 3725,528. Balance portion they will treat it as deferred government grant. In AS both the things were shown as 60 lakh. One component was shown. In IND AS, since the company has chosen for retrospective application, some portion you have to book it as financial liability. What portion they only given? A balance portion you have to show it as government grant. That's all. Excuse me. Okay. Next. Retained earnings of the company contain the following. One is the ESOP reserve we have, sir. Currently, we have an ESOP reserve. I think that's what we saw in the balance sheet. No, we have an ESOP reserve of 20,000. For that, they have given some breakup. The company had granted 1,000 options to employees, out of which 800 is already vested. Okay, that means 200 is yet to be vested or unvested. The company follows intrinsic value method for recognition of ESOP charge. Okay, AS recognize the intrinsic value method, but as per IND AS, we are following as per AS, as per guidance note of, we don't have any accounting standard for ESOP in, we don't have any accounting standard. We only have a guidance note released by ICA. ICA says, as per ICA guidance note, you can go for intrinsic value method. But IND AS says we have to go only for fair value method. So you will get different expense under both the methods. Okay. So you have got your adopted intrinsic value method for recognition of ESOP charge and recognized 12,000 towards vested and 8,000 towards and 8,000 over a period of ESOP charge for the corresponding reserve. So for vested option, they've recognized a charge of 12,000. For unvested, they've, as per AS, it is 12,000 and 8,000 respectively. So totally we have 1,000 options. That 800 is vested and 200 is unvested. For vested, as per accounting standard, you have recognized 12,000 and unvested, it is about 8,000. Just because it is unvested does not mean we will stop accounting the expense. No, expense will be booked over vesting period. Yes. Okay. All right. So 12,000 we have recognized towards this. This is as per AS. But we know in AS we don't follow intrinsic value method. We follow fair value method. If fair value method had been followed in accordance with IND AS 102, the corresponding charge would have been 15 and 9. So as per IND AS, it would have been 15 and 9. Okay. All right. So company intends to avail IND AS 101 exemption of share-based payment of not restating ESOP charge as per the previous gap for the vested option. So in case of ESOP, sir, what IND AS 101 ka transition option or transition provision says is, if the shares are already vested, then you need not adopt IND AS ka value. You can adopt AS ka value. In fact, what IND AS says is, IND AS encourages that both for vested and unvested use fair value only. IND AS encourages, not mandates. IND AS encourages that both for vested also you follow fair value only. But for vested, no, there is an option given to the company. If they want, they can go for fair value, or if they want, they can keep AS ka value itself. That is their choice. If it is vested, okay, which vested means the vesting period is completed. Now, what does the company wants to say? For vested option, they don't want to restate. Meaning, for vested option, they want to adopt 12,000. Is that acceptable? Yes. Okay, but for unvested option, there is no choice. Unvested option means after IND AS is applicable, the vesting period will get completed. For unvested option, there is no choice. Compulsory, you have to go for fair value only. Meaning expense has to be booked on fair value only. If it's already vested, means the vesting period has got completed as per AS. That's the reason IND AS gives a choice. For this, IND AS is saying, I'm encouraging you to take fair value, but if you want, you can ignore my encouragement and take AS ka value itself. And company is saying, I'll ignore yours. I don't want your extra gyan. Okay. So they said for vested, I want to choose 12,000. There is a choice and the company has exercised AS ka choice. All right. Or if they want, they could have gone for fair value also, but company has not gone for it. So it is not an imposition. There is just an encouragement. So this 12,000 value of vested option as per AS is acceptable. However, for unvested, they have to compulsorily go for fair value only. That means they have to book 9,000. So the required amount is how much? 12,000 plus 9,000, which is 21,000. These two addition. This is the expense requirement or SBPR ka reserve requirement. But how much is there? Reserve is only 20,000. We only just now saw. The ESOP reserve is only 20,000. ESOP reserve means we are calling it as SBPR. As in the IND AS terminology, we call it as SBPR. No? So existing amount is 20,000, but required amount is 21. That means the SBPR you need to increase. On reserve you need to increase. So what is the journal entry? The same. Retained earnings account debit to SBPR 1,000 and SBPR. Okay. So due to this adjustment, SBPR will increase by 1,000. And retained earnings will reduce by 1,000 rupees. Okay, that's what I've written over here. So due to this adjustment, retained earnings will reduce by 1 and ESOP will increase by 1. ESOP reserve will increase by 1,000. Okay, all right. Next, cumulative translation difference. The company had some non-integral foreign operations and it had recognized a balance of 1 lakh as part of this reserve. Okay, so they're showing some ESOP reserve. This is related to non-integral foreign operations. Non-integral foreign operation means as per IND AS, in IND AS 21 terminology, foreign operation ka functional currency and reporting entity ka functional currency is not same. If it is not same, we say non-integral. If it is same, we call it as integral. So integral, non-integral is words are not there in IND AS, but it was there in AS. But that's what it means. Non-integral simply means functional currency of both reporting entity and foreign operations are not same. On first time adoption of IND AS, company intends to avail IND AS 101 exemption of restating this cumulative translation difference to 0. So yes, so whatever on first time adoption, whatever balance you have in this FCPR or the FCMITD, whatever you want to call it, that you can release it to retained earnings. First time provision allows this. Okay, so hence, so that means what? This reserve balance will become zero. This you will release it into retained earnings. So retained earnings ka balance will increase. So how much is that balance? 1 lakh. So after you transition to IND AS, from 1 lakh, this balance will become zero. But however, due to this adjustment, retained earnings balance will increase by 1 lakh. Okay, that's all. I think all other adjustment is nothing. So due to all this, no sir, retained earnings finally will increase by 20,99,000. So how much was the retained earnings as per accounting standard? 179, which we have taken it here. Okay, due to transition adjustment, retained earnings balance will increase by 20,99,000 and it will become 22,81,000. That's all. If you just check now, problem looked very big. Yes, sir. Adjustment only, we see so much drama they've written, but hardly 3-4 components is changing. PPE ka classification change. Some portion was IP, so you reclassified. But the thing you need to be more majorly concerned about is the financial asset and financial liability wala classification. Do not forget that. That's all. But amount wise, only what? Only few reserves changed. That's all. Retained earnings changed. ESOP reserve changed. And FCMITD changed. That's all. Rest everything ditto. Correct. So classification becomes quite important over here, especially showing the correct amounts under financial assets and financial liability. That is one thing. Do not make a mistake. And also first show the asset and then show the liability. Sometimes they'll give you the balance sheet like this. As per AS, it's always liability first, asset first. They may give you the balance sheet like that. Josh may don't prepare balance sheet also like that in IND AS. The whole thing, I don't know. Maybe, I mean, they might deduct marks big time for that. Okay. Next one is Shaurya Limited. Same question. But I'll not go over all the questions. I'll just discuss some adjustments with you. That's the only thing that is relevant over here. Okay. So I'll just quickly run over this question. You can go through. This question is there in study material. I think it was there in one of the mock papers also, I think. No. Yeah. Don't remember exactly. Yeah. Here also don't see any reference. Yeah. Recently it's added to study material, new study material, but I think it was an MTP question mostly. Okay. So let's run over. Doesn't matter where it's come from. But anyway, as long as we have to go through this. Sir, other current liability includes 3,90,000 liability to be paid in cash, such as expense payable. You have a contractual obligation to pay cash. So is this a financial liability? Yes. But 60,000 are statutory government dues. Sir, government dues are not financial liabilities. Because if you want to call it as a financial instrument, it should be what, sir? It's a contractual. Financial instrument is a contract that creates financial asset to one entity, financial liability or equity to entity. So it should come as a part of contractual arrangement. But with government, we don't have any contract. So statutory dues are not financial assets or financial liability. So this 60,000 is not your financial liability. So what is your other current, in the question, I've given the data here only. In the question, you will be able to see other current liability as 450. Maybe if you want one, I'll show you. This is as per accounting standard, okay? This data is as per AS. As per accounting standard, other current liability ka total is 450. So now here, as per IND AS also, you will show it. But in this 450, no sir, financial liability portion is 390. Non-financial liability portion is, or other current liability ka portion is 60,000. So that you need to do. Split up, you need to be comfortable. Long-term loans and advance include 40,000 loan and remaining consist of advance to SAR. Both you have given a loan, so you have a contractual right to receive cash. So both are financial assets. I think on this loan, they have some adjustment. That's the reason they've called it out separately. We'll see that later. Other non-current assets consisted of 2 lakh of capital advance to supplier. You have given a capital advance means you have a contractual right. You have given it to supplier. So you have a contractual right to receive goods. So this is not a financial asset. Okay. So yeah, don't put it under financial asset. Show it under separate category. Other current assets. Other current assets ka total is 2 lakh. Okay. It includes, I think not total should not be 2 lakh. I think it should be 4 lakhs. Other current assets. Where is it here? Yeah, other current assets should be 4 lakh. There's a typo. Other current assets ka total is 4 lakh. Out of this 4 lakh, 3 lakh current assets receivable in cash. If you are receivable in cash, so you have a contractual right to receive cash, so it's a financial asset. There is a prepaid expense of 50,000. Prepaid expense is not a financial asset because you have a right to receive service, not cash. So this is non-financial asset portion. So classification of 2-3 components, you need to be careful here. Now short-term provision include dividend payable of 2 lakh. So they have already made a provision for dividend of 2 lakh rupees. It's there in short-term provision. The dividend payable had been as a result of board meeting, whereas the declaration of dividend for financial year was made. So board of directors have convened a meeting and they have proposed a dividend. But on the board of directors, once the board of directors confirm, will we account it? No. Only when the dividend gets declared in the shareholders meeting, only then we will account it. However, it is subject to approval of shareholders in the AGM. So that means dividend is not approved by the shareholders. So we cannot account it. But it is already accounted as per AS. As per AS also, we don't do it anymore now, but let's not question that adjustment. So they are saying it's already done. So you can't show this anymore. So you already made a provision. So you have to reverse the provision. So provision has credit balance. To reverse it, you will debit. So provision account debit to retained earnings you need to pass for 2 lakh rupees. So due to this, provision will reduce, retained earnings will increase. That's all is the effect of these two. Chief Financial Officer, not cheap, Chief, yeah. Chief Financial Officer of Shaurya Limited has given some extra data. He has some thought process. Let's see what he has to say. Property, plant and equipment consist of class of assets as office building whose carrying amount is 10 lakh. However, the fair value is 15 lakh. Company wants to follow revaluation model they're seeing on the date of transition. Is it acceptable? Yeah. For PP, you can go for fair value on the date of transition. So if you want to go for fair value, currently you're showing 10. If you want to go for fair value, you have to increase it by 5. So OCI balance will increase by 5 and PPE balance will increase by 5. Here they have not done it through retained earnings. They've shown it under fair value reserve. Here I'll show you. They've not put this under 5 lakh under retained earnings. They've shown it under fair value reserve. Okay. So it's a little controversial. Two problems they've done in different ways. You take a call what you want to do it. I'll leave it to you. Toss the coin. Whatever comes to your mind, you do it. Yeah. Okay. So that is the funda around this particular adjustment. The fair value of intangible assets on the date of transition was 250. However, management is reluctant to incorporate fair value changes in books. Reluctant means they don't want to go for fair value. Indirectly, they're saying they want to go for carrying amount as per accounting standard. Can they adopt? Yeah. Carrying amount as per accounting standard can be adopted as a deemed cost on the date of transition. So acceptable treatment. No change. Move on. Shaurya had acquired 80% shares in a company called Excel, one subsidiary is there, a few years ago, thereby acquiring the control on it. Okay, Shaurya recognized goodwill as per erstwhile accounting standard by accounting the excess of consideration paid over net assets acquired at the date of acquisition. Fair value exercise was not done at the time of acquisition. IND AS 103 says you have to find out goodwill by considering fair value of net assets. Okay, but when you find out as per accounting standard, fair value exercise was not done there saying. But when did this business combination happen? Before the date of transition. What does IND AS 101 ka first time adoption ka provision say? Past business combination need not be restated. Meaning any business combination which has happened before date of transition, you need not do whatever. Whatever you have done as per accounting standard, you can let it be. You don't have to touch that. So are they fine? Yeah. You can use that exemption. Past business combination need not be restated. So that means whatever company wants to do, that fair value exercise need not be done now. So they can ignore it and whatever goodwill they are showing, same thing they can carry it forward. The trade receivable amount of 20,000 include an amount of 20,000 as provision for doubtful debts measured in accordance with previous GAAP. Provision for doubtful debts is an estimate. There's an estimate as per the accounting standard. Now, as per the latest estimate, using hindsight, the provision needs to be revised to 25,000. So provision is based on circumstance. Okay, like when the circumstance was 25,000. I mean, when that time the provision made was 20,000. Later on, now in the date of transition, if you look back, provision will always be. Now, sir, it's simple. Now, when you're writing examination, you know that you have to prepare. Correct? Now, whatever time you have, based on that, you will prepare. Now, after the examination is over, you'll think, I should have prepared this chapter. I spent 10 hours for one IND AS 16. Maybe I should have spent only 8 hours for IND AS 16. 2 hours I would have spent on IND AS 101. Like that, you'll think after exam, you'll do this post-mortem case. Correct? But at the time of preparation, whatever you had to do, at that best decision you took, like that. Yes. So in future, you can always look back and say, I should have not done this. I should have done that and all that stuff. That is what they're saying. Okay. When you made the provision, 20,000 looked like an exact number. Now on the date of transition, you are saying, looking back and saying, you should have not made 20, you should have made 25. It in hindsight means in future, when you look back, you will always think like that. This is true for every aspect in our life also. But you don't have to go centi over here. There's an estimate. What is IND AS 101 ka provision says? Is there any error in estimate? No. You did a proper estimate. In future, obviously, estimates when you look back, it may feel that this was not that. It should have been like that. Okay. So that doesn't mean that it is wrong. It is just that in future, you have got extra information. So based on that, you can assess the estimates better. So based on that, revision can be called. So you have not done any error. First of all, accounting standard, you are using an estimate in accounting standard. And the estimate does not have any error also. I mean, this 25,000 totally you'll ignore. You don't have to do anything. Whatever you have done, let it be. Okay. That means debtor value you will not touch. You will not increase the provision at all because there is no error over here. Okay. This is just an estimate revision in hindsight. Okay. So you will not do anything. So whatever is the value of the debtor, I think value of the debtor is, as per accounting standard is 9 lakh. Even after transition to IND AS also, you will use 9 lakh only because error does not have any estimate. Okay. Just you have got extra information and you want to do the revision. Okay. So you don't have to do that on the date of transition. Okay. After you transition to IND AS, for the next year, if you want to do a provision, do it. That's fine. Now you don't have to touch it. Whatever is there as per AS, take over the same value. Okay. And then company had given a loan. Given a loan means it's a financial asset. worth 10 lakh to an entity for a term of 10 years, and the loan was carrying a 7% interest rate, principal liquid, blah, 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 they're saying. The fair value of this loan on the date of transaction is 50,000 as against the carrying amount of 40,000. Currently, as per accounting standard, the loan you're showing at 40, but the fair value is 50,000. However, Ind AS 109 mandates to recognize interest income as per EAR, effective interest rate. Yes, we do that. But in AS, there is no concept of effective interest rate. Management says it is a tedious task. First of all, simple, sir. As per thumb rule, all Ind AS 109 ka provision you have to apply retrospectively. Few things you need not apply, which we have already discussed. So all this also you need to apply it retrospectively only. Meaning from the beginning you need to work out and find out what should have been the value of this financial asset on the date of transition and adopt that. That's what you need to do. But management says it is a tedious task given the apply of in the given case to apply effective interest rate with retrospective effect. Hence, it is reluctant to apply retrospectively in the first time adoption. So they're saying it is not possible for us to do it. So what standard says is, ideally you have to do it retrospectively, but if you feel it is impractical for you to apply it retrospectively, maybe lack of data or whatever reason, if it is not possible for you, okay, at least find out what is the fair value on the date of transaction. Take that itself. You can't do it ideally you have to do it retrospectively, get its value on the date of transaction and record that. If you're not able to do it, just find out what is the fair value on the date of transaction, which is how much? 50,000. But currently you are showing how much? 10,000. Financial asset should be shown at 50. Currently it is shown at 40. So you need to increase the financial asset by 10,000 rupees. So journal entry will pass as financial asset account, loan account debit. This is not loan taken. This is loan given. So it's a financial asset. So asset value will increase by 10. Corresponding effect you will give it in retained earnings. So retained earnings also due to this adjustment will increase by 10,000. That's all you need to do it for this particular adjustment. In the long-term borrowings of 4.5 lakh rupees of component towards state in long-term borrowings of 4.5 lakh component is due to the state government. Interest payable on the government loan is 4%. However, the prevailing interest rate is 8%. Okay, so concessional loan we have received from the government. Okay, the fair value is 420. So should we have to do this now? What does the standard say, sir? If you have given any, if you have received any loan from the government at concessional interest rate, do it prospective accounting. So meaning whatever is the carrying amount of the loan as per previous gap, take the same thing. Okay. Here, what was the long-term borrowing as per the previous gap? 4.5 lakh. Same thing you show it as per Ind AS also. No need to do retrospective accounting. If at all you want to do retrospective accounting, you need to have all information that they have not commented over here. That means what? Ignore fair value and whatever is there as per carrying amount as per AS, take the same value. No need to do any changes. That's what I've written here. Under previous gap, mutual funds were measured at cost or market value, whichever is lower. That's what AS 11 says. You have to measure short-term investments at cost or market price, whichever is lower. Under Ind AS, however, the company has designated these investment as FVTPL method. So you're following FVTPL method. The value of mutual fund as per previous gap is 2 lakh. Okay. It is included under current investment. Okay. However, the fair value of the mutual investment and the date of transition is 2,30,000. So you have to find out the fair value. Correct. All this has to be done retrospectively, but on the date of transition, its value is 2,30,000. FVTPL method, no. So on the date of transition, find out what is the fair value of this, which is 2,30,000. But currently, the carrying amount of this investment as per accounting standard is only 2 lakh. Fair value is 2.3. Current carrying amount is only 2. So from 2, you have to increase it to 2,30,000. So how much is the increase amount? 30,000. So investment will increase by 30,000. Corresponding effect, don't say P&L. All transition adjustment here through retained earnings only. Okay, because these are all retrospective applications. No, so when we say P&L, we talk about current year P&L. We can't give the effect to current year P&L. Okay, so all this will be done through retained earnings itself. So this is the effect. Next is ignore separate calculation for deferred tax. Obviously, sir, if the asset and liability balance changes and if they give you tax rates, so you have to have some DTA, DTL impact also will be there. They're saying ignore that. Assume net deferred tax income. Whenever they give you net deferred tax income, it means deferred tax asset. So they're saying due to this transition adjustment, there is a net deferred tax income of 50,000 means there is a deferred tax asset of 50,000 that you need to create. You don't need to work it out. They only told deferred tax asset is 50,000. But currently, if you just check the balance sheet, you already have a deferred tax liability somewhere, I think. Yeah, you already have a deferred tax liability of 3,50,000. Now you're getting a deferred tax asset of 50. We know that we don't show both DTA and DTL. We knock them off. DTL balance is 350. Now we have to create DTA for 50. So DTL is only higher by 3 lakh. So in your new Ind AS wala balance sheet, show 3 lakh rupees. Okay, that's all it is. All that they've done over here and given all this goalie. You take a call based on marks. If it comes with just 8 marks, don't bother about theory. Just put up the new balance sheet. That was good enough. If it comes for little extra, give one line. Like for PPE, deemed cost exemption is available. For this one, you can adopt fair value on the date of transition. Like that, one point you write. Don't write stories and stories. Just one point is the good enough. Great. So with this, we have completed IND AS 101 revision as well. Kudos to us. Rolex, okay, whatever you say. So I have to play